The Nasdaq is currently closed, but the last reported price for Plug Power Inc. under the ticker PLUG was $1.98, reflecting a modest gain of $0.030 or 1.54% at the close of the regular session on November 26, 2025. That seemingly small move of 3 cents belies the much larger, more critical volatility that has defined this stock for months and, frankly, for years. The market's immediate expectation is that PLUG is merely bouncing along its psychological floor near $2, a low-cost entry point for retail investors who continue to bet on the green hydrogen future. However, a closer look at the reason for the recent stability after a significant drop reveals a far more complex reality that investors need to contend with. The company's recent capital raise, while providing a temporary lifeline, has also triggered a crucial high-stakes shareholder vote that is a direct consequence of their deeply aggressive short interest and persistent cash burn, a reality that completely alters the risk profile for anyone holding shares. The popular narrative surrounding Plug Power, particularly on platforms like Reddit and X, is one of an indispensable future leader in the hydrogen economy. The bullish argument is straightforward. Hydrogen is the clean fuel of tomorrow for logistics, transportation, and industrial applications. And Plug Power, with its vertically integrated ecosystem encompassing fuel cells, electrolyzers for green hydrogen production, and a growing distribution network, is perfectly positioned to capture that growth. This belief system is what has kept the stock from falling even further, acting as a conviction anchor for the retail base. But the reality painted by the chart and the financial reports is vastly different. The daily chart shows a pattern of extreme volatility, a high of $2.01 and a low of $1.92 in the last session alone, on volume that remains elevated at 87.11 million shares, indicating a continuous high-intensity struggle between buyers attempting to hold the $2 line and sellers reacting to the company's precarious financial position. The stock has been under pressure from its 52-week high of $4.58, demonstrating a massive loss of faith from previous price levels, a capitulation that goes well beyond general market weakness in the clean energy sector. The real immediate tension is not in the company's fuel cell technology, but in its balance sheet. And that leads directly to the core of the expectation versus reality conflict. Plug Power recently closed on a significant convertible notes offering, raising hundreds of millions of dollars. The expectation is that this cash injection buys them time to scale production, improve margins, and achieve profitability. The reality is that this financing came with a critical condition. The company must now seek shareholder approval to double its authorized common stock from 1.5 billion to 3.0 billion shares. This proposal, set for a vote on January 15, 2026, is a direct, unavoidable choice between two difficult paths. If the proposal passes, it provides maximum financial flexibility for future capital raises, strategic acquisitions, and funding contractual obligations, but it carries the heavy implication of massive future dilution for existing shareholders. If it fails, the company has explicitly stated that a reverse stock split becomes the primary path forward to manage its existing debt and warrant obligations. Both outcomes are bearish in the short term, but a failure to pass the authorization forces a reverse split, which is nearly universally viewed as a signal of desperation and tends to trigger further selling pressure. This single mandatory vote is the most important short-term catalyst, not a new contract win or a pilot program success. This brings us to the elephant in the room: short selling activity. Plug Power is one of the most heavily shorted stocks on the Nasdaq. a fact that is central to its daily price action and volatility. The latest short interest data shows an enormous concentration of bearish bets, with over 310 million shares held short, representing a staggering 23.73% of the float. This is not just a high number, it is a critical level that classifies Plug as a stock under severe short seller pressure. The days-to-cover ratio, which estimates the number of trading days it would take for short sellers to buy back all borrowed shares based on average volume, stands at approximately 2.46. While not astronomically high, this is a sufficient reading to suggest that a sudden rush of positive news or concentrated retail buying could trigger a short squeeze event, though the sheer size of the float makes such an event a high-risk proposition. The short sellers, including notable institutions who are often identified in quarterly 13F filings as having net short positions, are largely operating on the thesis of persistent unprofitability and continued capital raises leading to perpetual shareholder dilution. Their motive is clear. They see a company with brilliant technology but a fatally flawed business model that cannot turn its growth into positive cash flow, a position that has been consistently reinforced by the negative gross margins reported quarter after quarter. Moreover, we must look at the less visible short activity. Off-exchange short volume, often associated with dark pool trading, has recently constituted over 54% of the total short sales on certain days, which is a figure retail investors often cite on forums as a lack of transparency. While dark pool trading is a legal part of the market and does not inherently imply manipulation, its high ratio here suggests a concerted institutional effort to execute large sell orders away from the public eye, aiming to minimize downward price impact and manage their accumulating short positions. The short borrow fee rates, while still relatively low and fluctuating around 0.58 to 0.66%, are a metric that investors need to watch closely. A sudden spike in this fee would be an actionable insight, signaling that available shares to borrow are drying up, increasing the pressure on short sellers and potentially being a precursor to a meaningful short squeeze. For a retail investor, the actionable step here is to monitor the daily borrow desk reporting. Understanding the short thesis allows one to weigh the risks. Are the short sellers simply acting as the market sanitation crew, pointing out a broken financial model, or are they being overly aggressive in betting against a subsidized, high-growth industrial segment? This is the core debate raging online. Let's address the business fundamentals beyond the immediate trading floor drama. Plug Power is a pioneer in the design and manufacture of hydrogen and fuel cell systems that replace conventional batteries in material handling equipment and other mobility applications, with anchor customers that include major logistics and retail companies. Their business model has three main components: selling the core equipment like fuel cells and electrolyzers, providing hydrogen fuel and infrastructure, and offering service and installation contracts. The hydrogen production side, particularly their move into building a network of green hydrogen plants, is what excites the long-term holders. The idea is that controlling the fuel supply and the technology for consumption creates an integrated, high-margin ecosystem. However, this transition requires massive capital expenditure, leading to the substantial cash burn we've seen. The third quarter 2025 results highlighted this operational struggle. While the electrolyzer product line showed a strong increase in revenue, overall gross margins were reported at a deeply negative 67.9%, worsening significantly from the prior quarter. The massive cash outflow from operations over the first 9 months of the year, nearly $387.2 million, underscores why the company desperately needed the recent convertible notes offering. Looking ahead, the market is primarily focused on execution against the Project Quantum Leap initiative, which is designed to boost cash flow, reduce the cash burn rate, and ultimately improve those abysmal gross margins. This project hinges on increased sales volume, disciplined inventory and capital expenditure management, and securing better pricing. The company has secured impressive deals, such as the major electrolyzer supply agreement with Allied Biofuels, which validates the technology's appeal and the demand for green hydrogen. But the paper contracts need to translate into profitable deliveries and operational efficiency. The macro environment presents both tailwinds and headwinds. Government support, particularly in the form of tax credits and funding tied to the One Big Beautiful Bill Act, presents a substantial tailwind that the shorts are betting will be too slow to materialize or too dilute in its impact. The major headwind is the simple hard cost of scaling up green hydrogen production.